Welcome to the podcast from Morningstar UK, the leading provider of investment news, views and analysis. This week, we're focusing on the impact a no deal Brexit could have on the markets. UK Brexit Secretary Dominic Raab and EU Chief Negotiator Michel Barnier are currently locked in crunch talks over the future of Britain's trade terms with the European Union. With Brussels admitting there is no plan B for a no deal Brexit, the stakes couldn't be higher. So should investors shun UK assets and seek shelter in US assets if there is a no-deal Brexit? Or does the uncertainty create opportunities? Our first guest is Mike Coop from Morningstar Investment Management, who explains.
Should investors shun UK assets and seek shelter in US assets if there is a no-deal Brexit, and trade with the EU moves from current EU terms to WTO terms? This is the question markets have been asking, and tallies with the relative underperformance of UK equities, fall in the pound and gilts outperforming global government bonds. We know that forecasting economic turning points is unreliable, and political decisions have surprised investors repeatedly. So, favouring better value markets that are out of favour and has tended to be a better way of generating sustainable returns, and then stress testing portfolios to see how they might behave in extreme conditions. If you take this approach, UK equities look attractive whilst gilts and the US dollar do not over a full market cycle. The UK stock market is not the UK economy. 70% of revenues come from outside the UK, and the fall in the pound makes these offshore revenues bigger in pound terms. The banking sector here has gone through a long period of recapitalising and ongoing stress tests, so they are better placed to withstand big domestic shocks than before. Energy and mining companies are benefiting from reducing their cost structures in response to big falls in commodity prices several years ago. Compared to other equity markets, UK equities are better value and there is scope for profits to grow. UK gilts still offer very low interest rates for investors, pretty much locking in negative returns after inflation, whilst returns from cash are creeping up as interest rates rise. So we hold less in gilts than usual, as the very long duration of gilts means rising rates can quickly translate into losses. Finally, there is the pound, which is now close to the lows versus the US dollar seen in the wake of the referendum vote. While investors have enjoyed currency gains this year, the pound is so low versus the US dollar now that it is very undervalued. And historically, this has been followed by a rise in the pound and currency losses. So we remain cautious about the outlook for the US dollar over the medium term and hold fewer dollars than usual to protect our portfolios.
What impact does political turmoil such as a no-deal Brexit have on the markets? Morningstar Investment Management's Dan Kemp is up next and considers how the latest Brexit fallout will affect portfolios.
During periods of political turmoil, it's natural to think about the impact these events will have on markets in general, but also on your portfolio. And so people may be surprised by the lack of interest that investment markets appear to have shown in the Brexit news yesterday. We think there's a couple of reasons for that. The first is that UK assets already appear in the main to be underpriced, particularly equity markets and the pound. And so when so much bad news is priced in, they're not necessarily going to react to the next piece of bad news. On the other hand, gilts, which are where people tend to go to hide when there's bad news, look to us to be overvalued. And so again, bad news is not necessarily going to drive the price any higher. The second thing to remember is that there's no causal link between politics and what happens in investment markets. The two are very separate. Although we're very tempted to draw a line from one to the other, that can be a real mistake. So how should investors react to these circumstances? Well, given that political circumstances are so difficult to predict, we'd recommend putting them to one side and focusing on valuation instead. And remember, investment is not about what happens over the next few days, weeks, or even months, but over the next years and decades.
What does Brexit mean for your pension? Sterling weaknesses has been good for investors who own FTSE 100 stocks, but concerns are growing that Brexit is distracting politicians from other priorities. Senior international editor for Morningstar, Emma Wall, discusses this issue next.
When it comes to Brexit and pensions, it could be argued that there have been benefits to the Brexit vote, at least in the short term anyway. Thanks to sterling becoming weakened, the FTSE 100 rallied, which means investors in this particular market benefited. Also, the government has been too distracted by Brexit to tinker with lifetime or annual allowances as they have in previous budgets. But it is precisely this distraction which people are concerned about. According to a survey by Aegon, 8 out of 10 investors are worried that the government is just too busy with Brexit to get on with other important issues. Aegon says there is evidence of this. There was supposed to be a ban on cold calling for pension selling to come into place in June, and this has been pushed back. And the Green Paper on social care has been pushed back 3 times since the Brexit vote. Aegon, as well as other investors, seem to be urging the government to get back to business as usual as soon as possible when it comes to savings and investings, pensions important concepts.
But if you are nervous about Brexit's impact on UK stocks, there are plenty of global opportunities to choose from. In her latest monthly series, Killick & Co.'s Rachel Winter shares 3 lesser-known top stock picks within aerospace, fragrances and alternative energy.
Hi Rachel.
Morning, Emma.
And what's the first stock you'd like to highlight today?
The first stock today is a defence company called Northrop Grumman, mainly based in the US, and we think defence spending is quite topical at the moment. So Trump has been very vocal about the fact that many member countries of NATO are not spending enough on defence. They're supposed to be spending about 2% of gross domestic product, but many countries are spending well below that. For example, Germany is barely spending 1%. So Trump's quite annoyed about that, and he's really trying to up the amount that NATO members spend on defence. The US is spending about 3.6%, so well above the target, but Trump is really trying to push that target to 4%. So it really does seem as though global defence spending is set to rise, and it's a sector that we like very much at the moment. The reason we've picked Northrop Grumman in particular is that it's very much US focused, and it's also quite diverse in terms of the types of defence it focuses on. So it's quite exposed to the more traditional types of defence, such as strike, and it's also exposed to areas such as cybersecurity and satellite protection. So it's quite a diverse business, and it's in a very much a growing market. So we think it looks very attractive at the moment.
And how dependent is that stock on the US economy? Because opinion is divided as to how far the US economy will grow in the near future.
It is. Well, about 85% of their revenues come from the US government, so a very high proportion is dependent on the US. But I think it is fair to say that people are quite concerned about how far behind NATO has fallen in recent years in comparison to countries like Saudi Arabia and China, which have really increased their defence spending. So I think, although defence is a bit of a divisive issue, I think people would feel a bit more comfortable to see the US and the rest of NATO spending a bit more.
And what's the second stock pick today?
The second one is a Danish company called Ørsted. Now, this is one of the leaders in renewable energy. And we really think that renewable energy is becoming much cheaper. It's really declined in cost over the last few years. And now it is really being taken a lot more seriously than perhaps it was previously. So just looking at UK power generation, for example, we now get about 30% of our power from renewables, and about half of that third comes from offshore wind. So it really is quite a significant proportion of UK power generation. So Ørsted, the company that we've been looking at, yes, they're Danish, but about 46% of their revenue comes from the UK. And they actually believe that offshore wind capacity will grow by about 26% per year for the next 8 years. So the growth potential here really is quite high. And Ørsted is one of the major players with good economies of scale. So we think it's a very attractive company in what is very much a growing market.
And what is your third and final stock pick?
The third is a company called Gewaudan. It's a Swiss company, and it produces ingredients for flavours and fragrances. And it actually has about a 25% market share of this flavour and fragrance market. Now, the reason we're looking at this is that we've been looking at the UK high street and thinking what types of companies are going against the decline and actually doing quite well. And one of those is home fragrance. So companies making these luxury candles and luxury diffusers, they're really doing incredibly well. And you see companies like Jo Malone, Molton Brown, they're really thriving despite the fact that they charge you £60 for a candle. So those are doing incredibly well. And rather than investing directly into those companies, we're looking at the companies making the raw ingredients. So that's Givaudan. They're doing incredibly well. They think that the demand for essential oils, which they make, is growing at over 8% per year. And one thing that we like about them is that raw ingredients have to be grown to order. So that means that these fragrance companies have to order their supplies many months or even years in advance. So therefore, companies like Givaudan have quite good security over future revenues.
Now, you've mentioned a few big brands there. What would happen to this stock, say one of those big clients, those big customers like Joe Malone, cancelled the account? How dependent is the company on these individual clients?
To be honest, a lot of these major brands like Joe Malone, like Molton Brown, they do keep their suppliers quite confidential, so it's quite difficult to say. But all we know is that Givaudan is a major supplier. It's worth about 25% of the market, so I'd like to think they do have a vast range of customers, and if they were to lose one, it wouldn't be overly detrimental to their overall revenue.
Rachel, thank you very much.
You're welcome.
Does a strong US dollar create buying opportunities in Asia? A strong US dollar and trade war rhetoric has meant Asian equities have suffered this year, but JP Morgan's Joanna Kwok says the outlook is positive.
Hi, Joanna.
Good afternoon, Emma.
So we're here today to talk about Asia equities, around the theme of the fact that it's been a bit more challenging of a year, slightly linked to the US dollar strength. Perhaps you could quickly recap about the historic relationship between a strong US dollar and the impact it has on emerging and Asian equities.
Sure. So historically, a stronger US dollar has been negative for Asian equities. And this is what we have seen. US dollar strength has caused this year's kind of weaker Asian equities. However, we believe that US dollar is actually in a downward trend, on a multi-year downward trend. And during this period, there will be bouts of US dollar strength. However, the US dollar strength has actually meant Asian equities have become more attractive. And for us quality growth investors, this will give us more opportunity to add to the names that we like.
So then I suppose the next follow-up question is, what are the names you like? Where are the sectors that you're seeing the greatest opportunities?
Well, given that we're quality growth focused, the opportunities we find most are in three sectors. And they're the financial sectors, the consumer, as well as the technology sector.
And what about in those sectors? Have you got any specific names?
Sure. So within financials, we are thinking of the theme about financial deepening. And that would be the likes of Indian private sector banks, where we can find opportunities for the private, well-managed private sector banks to really gain market share for years to come, given the better run banks and management that they are. And the secondly is, for example, Chinese insurance. That's another space where there's still further penetration to go.
And what about within the consumer space?
Well, actually, for consumer, there's a lot of areas that we find interesting opportunities, but it all revolves around the lifestyle upgrade that we're seeing amongst Asian consumers, the secular trends we're seeing within that. And within that, there are a lot of examples we can get. For example, smartphones. Why do we buy a new smartphones? Really just for two reasons. One, we want a bigger and better screen. And the second, we want to take nicer pictures. And so, we can find interesting global leading companies that supply to the smartphone food chain. Component makers such as a camera lens maker we find in Taiwan that sells these triple camera lenses that we're using in the newest iPhone that we're doing. So that would be for technology. And then the third area is like demographics. And in Asia, we always think about aging population, and you would think about healthcare, which we do find quality growth names that we like, but also the younger generation. For example, Chinese Asian tiger moms, which everyone wants their kids to get into good university, and it's very difficult in China. So people pay up for their students to have after-class tutoring. And we find good, well-managed companies in that in after-class tutoring that we like, and because they're very fragmented, they're a national player, and they can gain market share for a year to come as well.
And before the camera started rolling, we were talking about the big name tech stocks, and you had an interesting way of looking at what looked like quite expensive valuations of the big names like Alibaba and Tencent, and you said actually they're not that expensive at the moment.
That's right. on headline PE, these names may appear to be quite expensive, but the way that we look at it, we're long-term investors, so we have like a 5-year outlook for the stock. In terms of, for example, Alibaba and Tencent, there's still a lot of areas they have yet to monetize. The monetization potential, given their their business model, really give them a huge opportunity to monetize for years to come. And so, on that basis, on a 5-year basis, at the beginning of this year, they were looking expensive, but having retreated in share price, their expected return has now gone up to like a mid-teens range, and we would be looking for opportunity to add.
Joanna, thank you very much.
Thank you.
Political crisis, trade disputes and environmental disasters are leading investors to reappraise their exposure to emerging market assets. And our very own Dan Kemp returns to explain how to successfully navigate emerging market investing.
"20 years on from the Asia crisis, the risk of investing in emerging markets is once again in the spotlight. Political crises, trade disputes and environmental disasters are all leading investors to reappraise their exposure to emerging market assets. In this environment, it's very easy to forget the advantages of emerging markets, as the bad news appears far more vivid than the good. When the news is dominated by international trade disputes, it's easy to overlook the good quality companies that are priced attractively and offer reasonable returns in most possible outcomes. Our focus on the most dominant news stories and opinions that reflect our own concerns come from well-known behavioural biases that act to conceal opportunities and prevent us from making the best use of our money. In order to overcome these biases, we need to be disciplined in the way that we look at investments and have an effective compass to lead us. When we apply this approach to emerging market investing, we see that the situation is not as bleak as it may appear. First, it's important to remember that emerging markets are not simply one asset class, but instead a group of assets, including shares, bonds, currency and property from a myriad of different markets and countries. While some of these markets are experiencing political turmoil, others are far more stable. Consequently, challenges in some markets can present opportunities in others. It's therefore important to adopt a bottom-up approach to these assets, looking at them in as much detail as possible rather than adopting a broad-brush, top-down approach favoured by many commentators. In doing this, it's worth remembering the quotation from legendary investor Peter Lynch: "Know what you own and why you own it." This can only be achieved by deep fundamental research. But there are so many ways to explore these opportunities that it's easy to get lost, and that is why it's essential to have an effective compass. At Morningstar Investment Management, we use valuation as a way of comparing different options and keeping us on the right path. As with all compasses, it won't deliver you to your destination immediately, but it will keep pointing you in the right direction until you get there. So as we think about emerging markets, we are seeing a growing list of opportunities. However, it's important to remember that the range of potential outcomes for a country in crisis can be quite wide. And therefore, it's often worth looking for assets that have suffered collateral damage from their association with the crisis countries. Finally, remember that the essence of investment is patience. We'll undoubtedly get to a point in the cycle when investors are struggling to remember the risks as the opportunities are far more vivid. But the journey ahead of us may appear long at times.
Finally, our last guest today is Fidelity's Dhananjay Phadnis, who explains to Emma that although Indian stocks look expensive, political reforms are creating sector-driven growth opportunities for investors.
Good morning, Dhananjay.
Good morning, Emma.
So I thought we could talk about India today. I know you have a whole of Asia remit and you're able to invest across the region. And there has indeed been a lot in the press about China recently. But India remains quite an interesting investment case, not least because we have some upcoming elections, don't we?
Yes, India has always been, one of those stories which are very remarkable in that the potential for India is enormous as you look into the long term. If you look at one of the interesting facts recently is that India is now the sixth largest GDP, country by GDP, and it's expected in the next 2 years it'll actually overtake the UK to be number 5. So, there's a lot of progress happening, but even at that level, India's per capita GDP is only $2,000 US. So it shows you that the potential for long-term growth in India whether it's consumption, infrastructure, healthcare, is just enormous.
And in the past, India has been rather stifled by bureaucracy, hasn't it? But now you've got a single party government, you've got interesting reforms coming through. What changes has the country made that have made it easier to invest in the region?
Yes. So India is still a very complex country, and it's many different states which come together. And you're right that this government has a majority in parliament, which has helped it with some reforms like the goods and services tax, the GST, which has been implemented some time ago. It had some teething problems, but now it seems like things are settling down. And there are also a lot of push by the government around some sectors like property. So they're trying to boost property through a lot of tax breaks for people to buy affordable property. So a lot of different things happening. Like I said, it's still a complex country, but it looks like a lot of things have come together in the last few years.
And how, as an investor, do you take advantage of this positive movement in terms of reform? Because the macro and economic and political is one thing, but actually making that into an investment case is quite another, isn't it?
So I do look at very much bottom-up stock picking, and while stocks are very different and companies are different, you can't ignore the fact that the strength of the economy or the direction of the economy is quite important for underlying earnings. And some of the secular trends, like I mentioned, consumer is a secular trend in India that will continue. I think the pace of change is driven by some of the things happening at the economy level, as well as a lot of the pushes that the government can make, which is healthcare and infrastructure and property. So a lot of things are coming together, and in fact, after a long period of disappointing earnings revisions, for the last several months, we are beginning to see a positive uptick in several macro indicators, whether it's automobile sales or it's property sales, and we're beginning to see some green shoots picking up.
And how are valuations in that country? Because there's a lot said about the developed world of valuations looking very high. And a few years ago, India, after the post-surge of Modi being elected, also looked quite expensive. Do you think this is an interesting entry point, or are things fairly valued?
No, India always looks expensive, you consider it in the conventional lens of looking at and comparing with different countries. For example, India right now on a 12-month forward basis trading almost close to 18 times, which is quite expensive in the global context. But what it means also is that investors believe and look forward to the long-term growth story in India, which is why they're willing to pay a premium consistently over the last many years. So while valuations are not very cheap, I think the real question is, can earnings live up to their expectations? And here I have a little bit of a concern, because valuations are while where they are, earnings expectations are quite high as well. So we are expecting high teens or even 20% earnings growth for the next few years, which is quite a tough ask, and we'll have to see how the companies deliver on that.
And you say, though, yourself, you are a stock picker, you do look bottom up. So these sort of whole of market figures might not necessarily apply for someone like you, where you're a stock picker. Where are you seeing the best opportunities?
So I've been very much focused on the large cap stocks, and I still see a lot of the opportunity in large cap stocks. In fact, if you look at mid and small cap stocks in India, they had become very frothy and expensive over the last 6 to 12 months. What we are seeing year to date is a clear change, where mid cap stocks are down almost 15%, but large cap stocks are actually flat to up as a whole. What you're also seeing is that there are positive earnings revisions in the large cap stocks versus the mid cap stocks. This is the area where I invest in, which is mainly large cap stocks. And within the large cap stocks, you find many companies which have earnings which are export driven. So the IT services companies or the oil and gas companies, as well as the healthcare and pharmaceutical companies. So there's large sections of the market which are domestic linked, but there are also many industries which are export linked. That, coupled with some of the economic recovery we are seeing, is beginning to feed through in earnings. So I'm finding some really interesting stock picking ideas, despite the more expensive valuation when you look at it from a top-down perspective.
Jay, thank you very much.
And that's the end of this edition. We hope you enjoyed this programme. From everyone here at Morningstar UK, thanks for listening.